Welcome to another episode of the Washington Retirement Planning Podcast. I'm your host, Ethan Meikle, and here we talk about all things that have to do with your Washington State retirement system, from your amazing benefits to the different tax strategies that you can utilize. Today's video is going to be about investment fees. So specifically today, we're going to go into the different types of investment fees that you're going to be paying, how much those fees can add up to over the course of your wealth or your working career, and what impact that's going to have on your overall net worth when it's all said and done. We'll go over the different type of fee structures you may face when you're looking at hiring a professional as well. Now, after we're done with our investment fee talk, the question that we're answering today is separating from a school district a wise choice if I can't actually retire with benefits until I'm 62? So we'll dive into that question at the end of the episode. So investment fees are something that nobody really likes to pay. It's one of those things that we just kind of have to do. No one's going to manage the money or invest for us if we don't pay them. So anytime you're investing money, unless you're trading everything yourself and buying individual stocks, there's going to be some type of fee associated with it. Even if you go through Vanguard and use their funds, they're the ones that are picking the individual stocks inside the ETF. Therefore, there is some type of management cost. So fees are out there. The point is never to avoid fees. It's to make sure that you're getting enough value in return for them. So a low fee fund doesn't always mean it's going to be better than the high fee fund. If the high fee fund, say, it charges you 2%, but returns 50% a year, and the low fund only is 1% a year, you can see that there's a very big difference there. And it might make sense to pay the extra fee for the extra value or growth. Now, that was just a completely off-the-shelf example there, but that is one thing you have to consider. It's not just the fees, it's what am I getting in return for that. And one thing that I always want to put out there is when you're looking at hiring a professional like myself, it's never about the portfolio or the money. I can give you all the stock that I use, or you can have the exact same portfolio, but there's still a good chance that you're going to underperform the market or what I do with my other clients, because there's an emotional component to it. There's tax strategies, knowing when to rebalance. So it's really the art of knowing how to manage funds. It's not just the stocks. It's not always just buy and hold. It's knowing when to sell, when to get out of the funds, when to hop on new trends before they start off with. When we're dealing with fees here, it's never just about the portfolio and the growth. There's often more to it, or at least there should be. Now, when you're looking at your investments as a whole, you got to understand that there's different layers of fees to them. So the first layer of fee is what we often call the record keeping fee. So most platforms, not all, but most, will have some type of fee. And oftentimes it'll be like a dollar amount, like it's $20 a year for the account or $30 a year per account. So it's a small little fee you probably don't remember ever paying or agreeing to when you signed up with, but it's one of those annual fees that they charge on a per account basis. And when they're doing record keeping, what they're tracking for you is when you put money in, when you took money out, the growth of it all. The most useful part is when you're doing tax planning is knowing what your basis is, how much of my gain is subject to taxes, is it not subject to taxes yet, to get that to the 1 year mark where I get a reduced capital gains rate, or am I still within that 1 year window? How much of my Roth contributions or Roth account is actually growth? And when I pull money out, have to pay a penalty on that funds if I touch it before my 5 years is up, or if I withdraw it before 59 and a half, how much of my Roth account is interest versus my contributions. So that's what record keeping does. They keep all that straight for you and just makes tax planning and stuff like that a lot easier down the road. So those are baked into most accounts. Second layer of fees is when you're paying some type of company or investment vehicle to use their fund. So if I want to use the Vanguard, S&P 500 fund, for example, they charge 0.02%. I'm agreeing to pay that fee. The trade-off is I don't have to worry about buying and selling my own stocks. They're going to do it for me, but there's a fee for that time savings there. And it's quite low. That's the way most people go about it. Third layer of fees is if you need more help. Like you don't know what ETFs to even pick. You want someone to help you do it for you. That's when you get to work with a financial advisor or an investment specialist, whatever they want to call themselves. That's the next layer on there. And then how they charge you will depend on how they set their own company up. Most common model is the assets under management, AUM. That's when they charge a percentage of your portfolio. A lot of people think that 1% is like the average, and it's the average if you have over $1 million, sure. Or if you work with someone that does like a lot of insurance. But I've seen those people always charge 1% because it's like the blanket, it's easy math is what it is. But that's not their book of business really. So they throw 1% like, oh yeah, we can also manage that money and here's the 1% fee. But if most of their money's being made selling, other products and they get paid commissions, they're not really too worried about that 1% fee because it's a small part of their book. They're after the higher commission payouts. If you work with someone that doesn't have the insurance side of their business, oftentimes you'll find that the fees are higher than 1%, especially if you have less than $1 million. And they can be what they call on a tiered basis. So oftentimes we'll see large firms will charge like 1.4% if you have less than 200,000, and then 1.3% if you have between 200 and 500,000, things like that. So they're stair-stepped on there. If you're thinking you're only paying 1%, I would push back on that and actually go ahead and look to see what the advisor fee actually is. And then you want to see what the internal portfolio cost is on top of that. So when you're looking for total, what my total fee is, it's the advisor cost plus the investment management cost. So you might have someone that charges you 1%, but let's say the funds they picked, on average, they're costing 0.6. Now you're paying 1.6% for a portfolio. Whereas you could find another advisor, let's say they charge 1.5%, but their internal cost was 0.02. That person's actually cheaper, even though their fee is 50% higher than that guy that says it's only 1% here. Because they keep their internal cost of their portfolio low, the overall cost is lower towards you. So it's not just the advisor fee you have to look at. What is the internal cost of the portfolio? All right, so let's dive into an example. So let's say you had someone that had $500,000 starting off with, and we're going to earn 5% per year. I know 5% is low, just go with it. 5% per year for the lifetime. And let's say they find an advisor, they're charging 1%, right? So 500,000, 1%, it's $5,000 for the year. Pretty simple math. Now, as that grows over time, that 500,000 starts to grow, so will the fee. It's going to come up with it. In a perfect world, if you could invest $500,000 at 5% and pay no fees, at the end of 15 years, you would have earned a little over $539,000 in interest alone. So you have a little more than $1 million, assuming no fees. But if we had a 1% fee compounded over time, you'd only end up with about $894,000. So the fees kind of eat into the account. You can see quite a bit there. So instead of $1 million, you got $894 because you paid fees along the way, that 1% fee. So the total fees for that 15-year period would be about $104,000. So 15 years, $104,000 in fees, what you pay, you end up with $894. When you look at it like that, you're like, oh, that's a lot of fees. I might as well just do it myself. But like anything else in this world, when you do it yourself, while you might save that cost, you also run the risk of making a bigger mistake that may cost you more, or you're going to spend more in time. And if you just took like a piece of paper and put a check mark every time you thought about money, the stock market, the portfolio, you read an article, you logged in a check, you're at some family function on your phone checking your accounts, that all adds up. It adds mental stress. It takes you away from your family. You're not living in the moment anymore. And that's when you gotta look at, is the fees worth it? It could be. The best explanation I had, didn't know if a fee was worth it, is if an advisor charged you a fee and that fee helped you earn more money than you could have done on your own, gave you back more time so you can enjoy doing things more that you love. If they prevent you from making a mistake that would have cost you that much or more in fees and hassle along the road, it prevented any type of mistake that would have caused an adverse effect to your wife or your kids, something like an estate planning issue that got missed, or some type of insurance opportunity that they could present to you while you're still young and able to get it, versus waiting until it's too late, like, oh yeah, we should have bought long-term care 10 years ago, but no one told me about it. So if an advisor can do any of those few little things, the fee's going to be 100% worth it. Because once your accounts start getting bigger, it doesn't take much to make a pretty big mistake. So if you're worried about like the stock market and like geopolitical events happening, and you're like, oh, I'm going to go in cash, I'm going to go into more of this bond stuff, and you missed out in the last 2-3 years of rally, and you missed 30% in growth, whereas the advisor would have kept you in there and held your hand through those markets or the times when you thought the market were down, but it didn't. That's easily, $200,000-$300,000 of lost revenue just because you had your own suspicions or worries about it. So those are just a few examples. It's always not cut and dry. So the main point here is just to understand what the fees you actually are paying and make sure you're getting enough value for it. Is this something that I can do my own, or are they really taking a lot of the time and stress away from it? Now, this is just the investment standpoint. I know most big firms out there, I won't name any names in the podcast, but if you join the Washington Wealth Breakthrough Group that I started, inside of there, we'll go into it and I'll show you statements. We'll go through email exchanges I've had with these firms, digging into their fee structures, how they work, what type of benefits they offer. That's all inside the Washington Wealth Breakthrough on there. But for now, we will just say big firms on there. When they're charging people, to help manage their money, that's all they're doing. They are money managers. They get your money, they invest, they charge a percentage, call it a day. You talk to them once or twice a year, it's 90% focused on the actual account and the performance in the markets. None of it really has to do with outside stuff, the stuff that you actually can control. Things like your estate plans, making sure your beneficiaries are updated, making sure you got your wills taken care of, that if you move states, you make sure that the will is current and will deal with their laws. It's also the tax planning part of it. Most advisors don't touch taxes. If you're paying an advisor a percentage of your wealth and you can't remember the last time you ever gave them a tax return, or they never sat and walked you through a tax return, then they're not doing the tax planning portion of it. You might be overpaying. Right? I know firms that charge the same fees I do, and they do a quarter of the work. They don't do any cash flow planning. They don't touch taxes ever, but they have loyal clients that pay them a fee because they look at their statement and the account goes up, so it must be doing well. And that's the worst way to think about it. If you can get more service for the same fee, that's something you really should pursue. And what we're seeing in the industry is that is the shift that's happening. It's no longer just money managers. It's people that do the full and comprehensive planning. But if you're someone that has somebody because they're either a family friend, you've been with them forever, whatever other excuse you have, now's a good time to look at it and say, hey, am I missing something? Because what are the odds that the person that charges you 1% doesn't look at your taxes might make a recommendation or give you some advice that might blow up in your face down the road because they didn't look at the tax return. If they said, hey, let's pull this money out, but they didn't know what your tax bracket was, you could be pushing higher brackets. You could force to pay extra Medicare. You could get penalized on your Social Security. You could have to pay adverse, taxes, like extra taxes that you weren't expecting because they sold off something that had some type of gain in it. Or sometimes they think they're savvy and they'll do tax loss harvesting for you without ever consulting you to see if that's something you want to do or will actually benefit you. And just because it might save a little bit of taxes now, it may cost you a little bit more down the road. So tax planning is a huge part of it. And I can't imagine ever giving someone advice without looking at their tax return now. To me, that's just pretty much malpractice. And there's a lot that can go wrong. And if something hasn't happened yet, it's only a matter of time. So if you have an advisor or think about one and they are not looking at your tax returns every single year, then that's a big red flag in my book, and I'd be looking at potentially moving to somewhere else that is going to be doing the extra work, the important stuff beyond just managing the portfolio. The portfolio management is important. It doesn't take it that much time. It's still the tax planning, meeting with people one-on-ones, coordinating with their CPAs and their attorneys to make sure everything is synced. That's where the real work and the value is. So if you're looking at an advisor, you're paying the percentage of fees, just get an idea of what's included in there and what's not, and ask them about the estate planning, the taxes. And if they ever give you we can't give tax advice, we're not CPAs, automatic red flag. There's no transaction a financial advisor can make that doesn't have some type of tax impact. And hiding behind I'm not a CPA, that just isn't right. And I'm sure the regulators, if they were ever audit them, isn't going to like that answer either. It's just a cop out. So make sure you're getting some type of tax planning through your advisor or through one of their partners to make sure none of the stuff gets missed. So at the end of the day, anytime you're paying a fee, you're going to end up with less money. Just the fact of the matter is, the main thing is that the fee that you're paying is protecting you against making potentially bigger mistake, or is earning you more money, saving you time that you would have invested on your own. Now, I'm talking about the AUM, Asset Under Management model here, because that's the most common way you're going to find. But there are advisors that charge hourly, and there are some that charge flat fees. I do it all. I've got people that pay me hourly for my time. I got people that pay flat fees, and I got the AUM as well. So I experiment all three models. They're all pros and cons. There's no perfect solution here. When you go with the hourly model, every time you pick up a call or join a call with them, you got to pay for it. And sometimes people will be hesitant to make the call or set up a meeting because they feel like they don't have enough questions to ask to justify the fee for the 30 minutes or the hour consultation. Or they think they can Google their way and they kind of just put it off. And that's not something you want to be either. You want an advisor that you can call them and ask questions with without having to worry about getting an invoice in the mail or saving up enough questions to make it worth the time. So when you're dealing with an hourly planner, that's some of the pushback you can get and what I've seen. And then the flat fee model, which is what a lot of people like, until they understand that flat fee does not mean it doesn't grow. The argument is a lot of people say that I don't want the AUM fee because it's based on my portfolio. If my portfolio goes up, my fee goes up. They think that the flat fee for whatever reason doesn't increase. And that's exactly the opposite. There's no business other than Arizona Iced Tea or Costco that's going to keep their fees fixed for life. So if I said, hey, I'll do the flat fee where I'll manage your entire portfolio and I'm going to charge you $5,000, that might be $5,000 year one, but year two, there's inflation. Software cost goes up, things like that. As a business owner, they have to increase their costs. Some will just increase arbitrarily based on their cost increases. Some will make up a number. Other advisors will tie it to the CPI index, and they tie it to inflation. Case in point, if you had something that was $5,000 and then inflation went up 3-4%, that fee can go up by 3-4% that year, even if the portfolio did nothing. If it doesn't matter if it went up, sideways, or down, the fee is increasing. The AUM model, if the fee stays the same, or if the account stays the same, the fee stays the same. If the account ever goes down, the fee goes down. And then if the account goes up, so does the fee. So to me, that's more in line with what you'd expect is as my market returns do better, the advisor earns more for it. In the flat fee model, your account does better. Your fee might not increase by the same amount of the growth, but it's still going up. And it usually works better for those with higher net worths, because in order to make it profitable, most advisors are going to do it for 5,000. They're going to do it for 8, 10,000. So if you have smaller accounts, flat fee model is not really going to work because it's going to be too high in compared to what you could have paid someone else if it's just charged a percentage. So for example, if you only had $500,000 and you had advisors that wanted to charge you 1%, we know that's $5,000, but the flat fee guy is going to charge you $7,000. That's more than 1%. So you're paying them for more. Now, if they're doing more, that's fine. You can go that route. When you're comparing to it, don't just go for the flat fee guy because you think it's going to be like that forever. Because remember, if that $500,000 goes down to $400,000 because you did a conversion, market fell, took money out, whatever reason, the advisor charging 1%, fee drops to $4,000. The advisor that's charging you $7,000, it's going to be $7,000 plus whatever they decide to increase it. So now you have less money, but now my fee's going up. So they're going to go in opposite directions. So it's always not cut and dry when comparing the different models. I've gone back and forth a million times between them all, trying to find the best mix. And the truth is there is no best mix. It's just finding what works, being transparent with it, and understanding how it all works. From a client standpoint, flat fee always sounds good. I know when I try to hire people, I always like the flat fee model as well. But when you dig down and look at how does it work in the long run and why haven't the big firms taken it over, it's a lot of paperwork and hassle. Every time a fee increases for fiduciaries like myself, I have to get a client to sign off on it. So if I change everything to flat fee model and I want to increase my prices by 4% for inflation, I have to go to every single household and get them sign off on it every single year. You see, it creates kind of a bit of a headache from an administrative standpoint on it. And if you ever don't like the fee, then you're kind of essentially forced out of the firm. They're not going to work with you. They drop you as the client from that standpoint. That's why I do use the AMM model myself versus the flat fee model. I use flat fee models if I'm not managing money, but if I'm touching money, that's when I usually will use the AMM model. It just makes things simpler. There's no annual signing or we have to do cost increases every single year. And so on the long run, to me, it seems to be a little bit more fair. The AM fees do fall down as the account gets bigger. Whereas when you're working with a lot of flat fee people, I haven't seen any that have ever capped their fees. And I've seen some that will increase their fees by 8 to 10% per year because they waited 1 or 2 years between raising fees. So you might see these bigger bumps in that fee model. So flat fee doesn't mean it's never going to go up. It just means it starts at a flat amount for the year, and then it's going to increase on an arbitrary number, usually based on cost of inflation, right, or cost of living. So the whole point is just be aware of the fee structure you're with, be aware of the advisor you're with. There's no right or wrong. Don't ever let the fee scare you from working with one or a certain structure, be that the red flag. The important part is just knowing what to ask, what to look for. And if you're not getting the value or which think the service you want out of it, there's no harm in looking elsewhere. Now, on to the question of the day, and that is separating from a district a wise choice if you can't actually retire with benefits until you're 62? So if it's a remote possibility that you could stop what you're doing and still support your lifestyle and wait till 62, then by all means do it. So if you have enough saved, outside, that you don't need to draw the pensions right away, you've got a spouse that's working, then by all means, yeah, you definitely could wait till 62 to get your benefits. However, seeing that you're asking about 62, I'm assuming you have 30 years of service. Once you have 30 years of service, the penalty for taking it before 62 is so small. I mean, if you took it at 60, it's a 5% penalty. It's not much at all. It's going to take you closer to 27 years to recoup the money that you would have saved by waiting those 2 years. So in other words, someone that takes their money at 60 versus someone that waits at 62, because you started collecting your benefits at 60, you collect it for 61 and then 62. You got it for 2 full years. That amount of money that's now you collected, it's in your pocket. Granted, it's a little bit smaller because of the penalty. It's going to be so much larger than what the other person would got in their pocket by waiting those 2 years that it would take that person that waited 62 about 27 years before they would have had the same out-of-pocket money withdrawn from the state, right? So collecting 2 years early, slightly lower versus waiting 2 years to get slightly higher benefit. It's usually over 20 years before those two actually catch up to have the same total distributions from the state. So if you're looking for total wealth, what can I totally draw from the state? The person that collects at 60, it's going to be well ahead. And by the time you catch up 20-some years on the road, you're going to be in your 80s. At that point, you probably don't care anymore. You lived your life. Life in your 60s is a lot different than life in your 80s. I'd rather get a few $100s less today per month to retire 2 full years early than be sitting on my couch in my 80s with a couple extra $100 a month going to my paycheck and not having the energy or the health to do what I want to do. So that's my personal take on it. I'm a big fan of early retirement. Knowing the systems, how it works, is how I'm able to help most of my clients retire about 2.5 years early. It's about 930 days earlier than what they initially intended. And it doesn't always have to be someone that has 30 years of service. I've helped plenty of people that don't have 30 years of service that are, 63, 65, 67, that thought they have to work longer. And once they go through the numbers, understand the penalties, they find out that quickly that working an extra year or so just isn't worth it anymore. The longer you work and pay into your pension plan, you start realizing the less and less is actually growing. And the benefit of going over a year starts becoming less and less over time. So example, so let's say plan 3, your average salary was $70,000 per year, right? Remember, plan 3, you get 1% per year that you work. So if I go 10 years in plan 3 system, I'm not vested. 10 years, it's giving me 10%. If my average salary stays the same, doesn't go up, let's say it's $70,000, I am now entitled to $7,000 a year in benefit. If I go one more year, go my 11th year, I know I'm going to get another 1% added on there, which, 1% of $70,700. So my benefit went from $7,000, now it's going to be worth $7,700. So it's a 10% benefit for going that extra year. That's how much my annual pension just grew by because I put one more year in. But once you're in year 30, if we're getting 30% of 70, now we're at 21,000. Same thing. If I go for my 31st year, the benefit's only 700 in this case. Now I went from 21 to 21.7. It's like a 3% growth. So it's not growing as much anymore relative to what the pension already accumulated. So in your early years, it starts accumulating faster. And as you get older, the benefit of going over a year is, in terms of just a net pension payout, is a lot less. Yes, you still get paid your salary and stuff, and that's important. But if you're only working because you want that one extra year, because you think the pension is going to be that much higher, or you're trying to avoid the penalty, most times, unless you're really tight on money, it ain't worth it. You're better off retiring and collecting the benefit right away. All right, so that's my take on it. Is it a wise choice? Really depends on your situation. I personally just say, if you got the 30 years of service, you're ready to go, most times it makes sense to start collecting benefits earlier. Now, you have to have your expenses under control and you have your budget in place. You should have enough funds invested outside of it to support the lifestyle. But if you got all that in check, by all means, collecting before 60 is usually my preferred method and how I like to see people go out. All right, so that's a wrap for today's episode. If you guys haven't done so yet, the link in the description below is to join our new free community, the Washington Wealth Breakthrough Group. It's a free training where I cover all of your Washington State benefits. I just released a video on how to read your benefits or your pay stub. So if you ever looked at your pay stub when you got paid and you're like, I don't know what these means, I go through it line by line. So I pulled various pay stubs. So I've got teacher pay stubs on there. I got people that work for the city, water sewer district, and things like that. So inside Washington Wealth Breakthrough, you've got access to the community of over 100 different Washington State members. You can ask questions too if you need to. I'm in there to help and support you along the way. We have one free Zoom call per month where it's question and answer. I'll pop in, you can ask your questions. I also have a course I'm working on. So it's a free training. Currently it's over 3 hours long, going over all your different amazing benefits in detail. So if you like the stuff on YouTube or on the podcast, this is going to be a little bit slower because I want to make sure you guys understand how it all works. And we'll go through it line by line to make sure you understand your benefits better than your HR department. And just today, I just dropped the video explaining how your pay stub works. So if you ever looked at a pay stub and wasn't sure exactly what all of the line items mean or those benefits, you just need some help understanding it, what you're looking at, I've got that broken down. I pulled a few different pay stubs from clients that work in different areas of the state, so you can kind of see the different payroll systems, how things lay out, how different employers will punch in or code the different line items, because they can actually vary quite a bit from employer to employer and can get confusing quickly. So that video just launched today. It's free to join. The link is in the description below. I hope to see you guys there. Until next time, remember that your future depends on what you do today. All right, before I sign off, just a real quick legal disclosure that we're required to say as licensed fiduciary advisors. So remember that this is a podcast. It is designed for educational and entertainment purposes only. I don't know you personally, therefore I cannot give you any personal advice. So please don't take anything that we say on the show as being personal, financial, legal, or tax advice. If you want that kind of stuff, make sure you seek out a professional so they can help you with the strategies and investments that are right for you. Also, please remember that despite the name of our show, we are in no way associated with Washington State or the Department of Finance Systems or any other Washington employer. We're a private-owned firm that specializes in working with Washington State employees, which is why we know so much about this stuff. So remember, we don't work for the state in any way, shape, or form, so please don't confuse us as being an official representative of the state. All right, that's it for the legal stuff. I'll catch you guys all next time.